Personal finance practice problem using Excel. High short-term loan rates, annualized. Prepare to get financially fit by practicing personal finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're down here in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information's on the left-hand side. We're going to populate that into the blue area on the right-hand side, looking at our payday loan, which are typically going to be short-term type of loans less than a year, usually having very high interest rates, and we want to think about the impacts of those interest rates. Now, remember, normally, if someone doesn't say otherwise, when someone gives an interest rate, they usually mean it's an annual rate. In other words, even when you're talking about something like a car loan or a loan on a home, if you were say, what is the loan rate on, say, a mortgage, and they say 5%, they mean 5% a year, even though you're going to be paying it monthly. So that's the normal convention. But we can, of course, represent the percents on a monthly basis. One of the reasons we don't normally do that is because it usually brings the interest rates pretty low, meaning you're talking about interest rates that are going to have fractions, and they might be below 1, which are difficult rates to basically talk about. However, if you're talking about fairly high rates, for a short period of time, then they might be represented in these terms. And the thing that's confusing about them, and the way they can be somewhat deceptive, is that we can hear these rates and compare them to our convention in our mind, which are usually annual rates, meaning when you hear a rate, your normal thought process is, because it's been trained to be this way, so this is our convention, to think of that's an annual rate, even if you're talking about a monthly loan. But if someone gives you a rate for something under a year, then it's substantially different, and that kind of thing can be used to basically deceive. So, and that's one of the accusations of these short-term loans, that they have these deceptive practices. But just realize, well, we'll talk more about that in a second here. But if you're looking at something that gives you a rate that's other than an annual rate, then the typical thing you want to do is annualize the rate so that you're comparing the same thing to the same thing. So you know what the convention normally is in your mind is annual rate. So if the rate here says the payday loan charges for a 4-week loan for 4.25%, but that's the rate for the 4-week loan, then they gave you a 4-week loan percent instead of an annual percent, which you would generally take the annual percent and then break it down to the rate for the 4-week time period, which is the term of the loan, which is not what would normally happen. So they're just going to give us that percent. It makes sense to do that, by the way, because obviously, when you're dealing with someone, you're going to say, I'm going to charge you 4-point-some% for this short-term time period or something like that. It can be more clear in communication, but it can also be somewhat deceptive in that, again, it goes away from the convention. So then we have so what we will normally do is say, well, let's annualize that, and then we'll think about it in terms of the investment. So we can annualize it without any kind of investment or actual dollar amount taking place, and then it's often useful to look at a dollar amount. So let's first annualize it. And this is often done with, like any time of interest rates, oftentimes the regulations will kind of require people to give the annual rate as well, because that allows people to do the proper kind of comparison. So we're going to say this will be equal to, we're going to start off with the 4.25. I'm going to make this cell a percent by going to the Home tab, number group, percentify it, add a couple decimals to it. There's the 4.25. And then we're going to have the periods in a year. So how many periods are in the year? If this is a 4-week loan, I'm going to do it this way. We're going to say the weeks in a year. Weeks in a year. And this is a number that you kind of just want to know how many weeks are in a year. You can look it up, obviously, if you want to find it, because we're talking about 4-week time period. You might say, well, that's kind of like a month, 4 weeks, but really months are like 4.3 months in a year. So we don't really want to use a month. You can kind of estimate it with a month. It'd be closer if we were to estimate with a number of weeks in a year, which happen to be 52 weeks in a year. And then we can take the loan period in weeks. The loan period in weeks is 4 weeks. Let's add an S there. Is going to be the 4 weeks. So this loan is going to be a 4-week loan. Let's underline that Home tab font group, underline it. So then we'd have the periods in a year. So how many periods would be in 1 year if we're talking about 4-week time periods? We're talking 52 weeks divided by a 4-week time period. That means that would be 13 periods in a year. So if you're telling me 4.25 for a 4-week time period, then if I was to annualize that, given the fact that there's going to be 13 of those time periods in a year, that would give us, this would be equal to the 4.25 time or divided or times the 13. Let's add a decimal there and add some percent, home tab, number group, percentify, add a couple decimals. So it's 55.25, which again is a huge percent on a normal annual loan. And that's why these payday loans are often, they're often regulated and whatnot. But also note that there's pros and cons to that, because of course, if you're given a short-term loan that's going to be, less than $100 or something like that, and you're only given the loan for 4 weeks, then just to process the paperwork of the loan and the fact that the loan is very unlikely to, the rate of default on these loans are quite high, then obviously you would have to charge a really high interest rate for that type of loan in order to make a business out of it. And actually they've actually removed some of these payday loans are not as available. And note, if you're talking about someone that needs a payday loan because they need that short 4-week loan, and you take away the actual legitimate regulated business, even though they charge high rates to make a profit, then your only option is to go somewhere else, like a pawn shop, or go to a black market type of loan operation, which isn't regulated, of course, at all, which would be much worse. So there's no regulations on what they would charge. So there's kind of both sides of the debate in terms of what would be, you would think it would be better off to have a regulated profit-seeking company that is charging the fees that they need to in order to run a business, rather than have a black market, running the business because we regulate it out. So it's kind of an interesting debate. But in any case, you want to annualize the rates so that you can take a look at them. So we're going to then select these items. Let's indent this. We're going to go to the Home tab, Alignment, Indent, and then we're going to go here, Home tab, Alignment, and Indent again. Let's put an underline, font group, and then underline. Now, you can also imagine the other scenario. What if they gave us the 55.25 annual interest rate and they said it was like a 4-week loan? And then you'd have to figure out, well, what would be the rate that you're actually charging me for the 4-week time period to figure out how much interest you're paying. Let's say they did it that way, right? They'd say, okay, well, that means your annual rate is going to be that amount. Let's bring that back down to the interest rate for a 4-week time period. You'd have to do this then. You'd have to say, all right, well, that means that the annual interest rate, I'm going to say, is this 55.25, and we're going to say numbers, percent, add a couple decimals, and then we'd have to take the fraction of a year, and we'd have to say, okay, that means that the loan period we said was 4 weeks. Let's just call it loan period is 4 weeks. I'm just going to pick that over here out of the weeks in a year. We're going to say weeks in a year. So the fraction of a year we'll be calculating here. Home tab, fraction of the year, we're calculating here. And that's going to be the fraction of a year. Fraction. And this is going to be equal to the 4 divided by the 52. And let's add some decimals. Number group, adding a couple decimals. We'll underline it. Font group and underline, and that would give us the interest rate for the 4-week time period, which would be equal to the 55.25 times that percent, or that number. We're going to say then number group, percentifying it, and then adding some decimals. So there's our 4.25. So you can see, if you were trying to talk to somebody about how much you're charging them, even if you're trying to be clear, you'd probably say 4.25 for that 4-week time period, as opposed to saying 55.25 a year, not simply just because it sounds outrageous when you say that, but also because if they want to break that down to the 4-week time period, they'd have to do this calculation to see how much interest they'd be paying, on the 4-week time period. So again, let's go ahead and indent these and format it. We're going to go to the Home tab, Alignment, Indent, and let's indent this one as well, Alignment, Indent again. Okay, so now let's just think about this a couple different ways. We're got the interest per period. Let's think about the actual investment of $1,000. Oftentimes these loans are quite small, even under $100 or something like that. But let's say that we got the 1,000, just have a nice even amount here. So we're going to say it's the 1,000. and we'll say 1,000. And if we're charging 4.25 for the 4-week time period, so we got the interest for the period would be the 4.25. How much would we actually be charging on $1,000? Home tab, font group, and underline. Let's make that number group and percent. Add a couple decimals on it. Let's actually make this 100. Let's make this $100. There we go. So we got $100 and then 4.25, and then the interest then would be for that time period. Interest would be equal to the 100 times the 4.25, adding a couple decimals, numbers, couple decimals, we're at the 4.25. And so the amount of the repayment amount then that we would have would be equal to 100 plus the 4.25, adding a couple decimals, number, a couple decimals, for 104.25. You can also get to that interest amount this way a little bit more quickly. You can, or the amount of the repayment. We could say we can take that $100 for the investment, and this probably should be called the loan, not the investment, depending on whose side of the line you're talking about. So the loan, we're going to say $100. The rate is going to be equal to, we're going to say this time, the 4.25 plus 1. And let's go up top, and we're going to go to the numbers, percent, and that's going to give us 104%, underline, font group, and underline, and that'll give us the repayment amount, which would equal to 100 times 104. And so let's add some decimals, numbers, couple decimals. We're at the 104.25. So then if we go to the interest for a year calculation, if we were to think about it as the annualized interest rate, if we have the amount of the loan at the $100, and the annual interest rate, if the loan was for an entire year, we said the annual interest rate was that 55. We're going to go to the number, percentify that, add a couple decimals, underline it, font group, and underline it. That would then give us the interest for the year if it was a yearly loan, meaning if we had that as a yearly loan and we use that annualized rate, that would give us the $55, which of course would be quite large if it was a loan for the entire year. But again, note that loan's probably taking into consideration just the processing of the loan for a very short term loan as well. So, but anyways, that's going to give us the 55.25. And then we got the repayment of the loan then, if it was for an entire year, would be 100 plus the 55.25. And so number group. So as you think about longer terms, you would think that, obviously that rate would be more and more ridiculous, right? If you think about a week-long loan or something like that, then, it's kind of different. But in any case, we're going to say the loan, we can also calculate that this way a little bit faster, same thing. The annual interest rate is now going to be equal to 1 plus this interest rate, and that'll give us the repayment amount. So the number, percent, add a couple decimals, and then let's say this is going to be actually 1 plus the rate. Let's say this is going to be 1 plus the rate, and underline here, underline that, and then this is going to be the repayment amount. The repayment amount, which would be equal to the 100 times that 155.25, giving us directly to that number. Once again, number group, and adding a couple decimals. One other way we can see this that kind of might drive the point home a little bit more between this annualized amount and the 4-week amount is to run it back this way. We can calculate the annual interest rate this way. We could say, well, what if I took that interest for the 4 weeks and we took the loan amount, which is going to be $100, and we said that the rate is going to be equal, we're going to take the rate for that 4-week time period, 4.25, and go to the numbers, make a percent, add a couple decimals, underline it, font group, and underline, and that's going to be then our interest for 4 weeks, which I'm going to put in the outer column. This equals the 100 times the 4.25 that would be equal to, if I go up top numbers, add a couple decimals, we're at the 4.25 of the interest. Let's indent this, home tab, alignment, indent this one, alignment, indent again. And then we've got the periods per year. If we think about the periods per year to kind of annualize this thing again, we got the weeks in a year, which are 52 weeks, which we'll just know that. We just want to memorize there's 52 weeks in a year about. And then the loan period we said was 4 weeks. So there's 52 weeks in a year. The loan period is a 4-week loan. So that's going to give us the periods in a year. If we're talking about 4-week time periods, this will equal 52 divided by 4. So that means there'd be 13 of these 4-week time periods in the 52-week year. Let's underline this. Go to the Home tab, Font Group, and underline. Let's indent these by going to the Home tab, Alignment, Indent. And here, Alignment, Indent again. And then this is going to give us the amount of the interest per year. So if we were to think about the interest per year and we were paying the 4.25 every 4 weeks for the 13, that would give us about the 55. Let's underline, Font Group, underline, add some decimals, number group to the 55, which would give us the 55.25. And then the loan amount, comparing that to the loan amount, which was $100, can get us to that interest rate again. So that'll give us to the annual interest rate, which we're going to say is equal to the 55.25 divided by 100. And we're going to go to the number group, add a couple decimals. There's that 55.25, our annual percent that we got to up here. So going back and forth between these can actually be somewhat confusing. And even if you're trying to be honest and talk about, what the charge of the interest is that you're charging for the loan, it can be confusing. And of course, there are people that are trying to be dishonest and deceive, which further complicates the problem. So it's kind of useful to go back and forth between some of these numbers and just look at it and think about, well, how would you, if you were trying to, communicate this kind of process fairly or unfairly, what kind of language might you use just to be aware of it, and then how can you verify for yourself with these different kind of loan rates when you encounter them.